Okay. Welcome. These sessions will be recorded. I'm pleased you could join us for the Business Education Resilience webinars with 1917. My name is Pauline Marquardt, and I'm the Executive Director of the Greater Bowie Chamber of Commerce, which is made up of members with common interests and concerns related to the business environment in the Bowie area. It is the primary professional trade organization in the Greater Bowie area dedicated to the protection, enhancement, and success of business and Bowie community. The Bowie COVID-19 Business Recovery Assistance Program delivers online technical assistance to help Bowie businesses accelerate their post-pandemic economic recovery. This program is a collaboration between the Greater Bowie Chamber of Commerce and the Bowie Business Innovation Center and funded by the City of Bowie. During this webinar, it's best to be comfortable with your video on. Remember to mute yourself. Please ask questions through the chat unless otherwise directed. Welcome, William Eric Lindsay, Senior Business Counselor of 1917. Hello.
Hey. Hello, Pauline. Hey, Horace, how you doing? Just glad to be here once again. This is really fun. And I just want to pull up this PowerPoint slide. I'm going to share my screen. And before we begin getting into the presentation, I just want to say thank you to the Greater Bowie Chamber of Commerce for once again selecting me and my team to put these webinar series together. So definitely a lot of gratitude to the Greater Bowie Chamber of Commerce. If you're not a member of the Chamber of Commerce and you're watching this, please join. Definitely join the chamber. So as Pauline mentioned, one of the things that we do is this is called the Business Education and Webinar Series. And it's a 2-section, 12-part webinar series. So there's 24 webinars. So this is session 9 of the first part of the 12. The second part starts April 15th. All right, after you file your taxes, jump back on board. We'll be here again. So this is session 9, and we have 3 webinars left remaining in this particular section. So we chose to go with a programmatic approach. So from day one, from the very first webinar, we built upon each webinar. So, today we're going to be talking about a certain topic, business equity and valuation. And the very beginning, we talked about goal setting, business planning, PPP and EIDL loans. Then we talked about financial literacy. Then we talked about, emotional balance and work. And then we talked about some food industry pivoting, which was a really good one. They're all good, by the way. And so we talked about all those operational management business in our business. And we also got, again, like I mentioned, we also had an update on the PPP and the EIDL. And there's a few changes there. And that gentleman will be back later in the summer to give us another update. So please, watch out for those dates and times. So the grand finale, which is actually webinar number 25, we added a webinar, and the grand finale is July 15th. And that's where we're going to have a picture business competition. So we would love to have you sign up, and Pauline, you and I will work together to start signing people up for that competition on July 15th. So it's a picture business competition, some great prizes. First place prize is going to be really good. We have a second and third place prize as well. So we look forward to having as many business owners who were part of this whole process to sign up and take part in that. We'll obviously select the first place winner. They will receive a very, very wonderful prize that will help you with your business. So speaking of pitching your business, one of the things I would like to ask you is please sign up and sign up for all the webinars, and please return for not just the final 3 that we're pushing, but also the next 12, which will start April 15th. So with that, let me stop sharing and let's get into the slides. Let's get into the presentation. So again, my name is William Lindsay. I'm the owner and senior business consultant for 1917. That's my company. I'm a business coach, and I'm also an accredited business consultant. Been doing this for a number of years, like 27 years in different areas, different fields. And, started my company about 8-9 years ago and haven't looked back since. It's all been fun. And I love what I do. I really, really love what I do. So, oops, wrong slide. Let me share this other slide with you. There you go. That's the right one. Oops. Okay, now I'm having a little bit of a challenge here. That's the one I want to slur. All right, let's pull up the right slide. Okay. There we go. That's a lot better. Yep. So like I said, I've been doing this for quite some time. I love what I do. And so let's just get into it. So today we're going to be talking about what is equity. We're going to talk about ways of measuring business equity. We're going to get an idea of your current equity. And we're also going to talk about ways of increasing your current equity and valuation, your business valuation. And we're also going to talk a little bit about why do you want to increase both your current equity and valuation. And then obviously if you have any questions, please just, you can type them in the chat. Pauline's going to monitor the chat for me. Or what you could do, if I'm not mistaken, you can unmute yourself and then ask a question. And I would love for this to be interactive. So if you have any questions, please just go ahead and ask those questions. So when we think of, let's approach equity and valuation as looking at your house, right? We all live in a home or some kind of adobe, and we think about what is the value of the property that we have. So what is the valuation of your home, right? So from a business perspective, think of it in those terms. We are building the valuation of your business. Like for example, if you have a home and you're trying to increase value, you would add to it. You would finish your basement. You might put up some new walls. You might add a bathroom. You might put an extension on your house. You might go add another floor to your house, if possible, by zoning code, of course. You may do some improvements, improve the kitchen, for example, and improve some of the living spaces. You're adding value to the house, right? So because once you sell your home, you can definitely improve the sale price of your home. That's basically what we're doing in our business. We're adding things to our business to improve the value of our business. So that's the way we want to think of it. So what exactly is equity? So as you can see in the slide, it's the money value of a property of an interest in the property in excess of claims or liens against it. So essentially, if your business is worth $100,000 and you have $10,000 lien against it, again, your equity is the subtraction of those two. It's 100,000 minus 10. So your equity is about $90,000. Very straight line, very method, very simple right now, but we'll definitely get into it. And it's also referred to as a shareholder's equity. Okay, so that's essentially what equity is. Business valuation is just a process of determining the economic value of your entire business or company unit. Now remember, when we say business, you can also have a company unit. So if you have a larger organization and you can say, well, you want to sell the R&D portion of your company, well, what is the valuation of the research and design part of that particular company? What's the value of that particular subunit of your company? So the business valuation can be used to determine the fair value of a business for many different reasons. So if you want to sell your business, let's say you have to know the value. Obviously, you want to know the fair value, market value of it. If you want to introduce investors to your company, you want someone to understand what they're investing in. So they need to know, okay, what's the current value of your company? I have to be honest, sometimes even through divorce proceedings, through the court system, when you have a divorce and a husband and wife own the company, well, those things need to be separated. Those things need to be divided, whatever court, litigation, whatever the lawyers come up with. Then both lawyers need to know what's the value of the asset, and that's the asset's the business. So, you definitely want to turn to a professional evaluator to understand the entire process of looking at the valuation of your company and even the equity of your company. So one of the biggest takeaways that you can take away from this particular webinar is if you really want to know your equity and your valuation, you certainly want to talk to your CPA, your tax preparer, and your CPA. You definitely want to have your CPA on board to look into the documentation of your business equity. Now, in previous webinars, we went through projections, some of the financial statements, and we also went through financial literacy. So That information will also be shared here up to a point. You can always go back and look at those videos to really understand if there's any questions on, those business documents from a financial accounting perspective. Now, where do we find a lot of our business valuation and business equity information? It's definitely in our balance sheets. Okay, and from the financial literacy side, literary side, this is where we find the sweet spot in terms of finding out what our valuation is. It's from our balance sheets. So there's a variety of different types of equity, right? There's obviously a stock. Someone can own stock in a company. There's stockholders' equity. Okay, that's a type of equity. There's a fair market value, which is the value of the property in real estate terms. So remember, I used the analogy of your house. So if you have any realtors on here, please jump in and correct me if I'm wrong. But let's say, for example, if you're a realtor and you're working for your client and they're going to sell their house, well, you obviously need to know what the comparables are in a certain radius of the house that you're about to put on the market, so that you can have a fair value price for that house in that area. So if the fair value of most of the homes that are comparable to what's being sold are, let's just say, $500,000, if the realtor puts your house on the market for $2 million, well, that's probably not gonna sell. Just from that perspective, it's definitely not gonna sell. So you want to understand what your business looks like from a fair market value. So it's a comparative way of looking at your business compared to other business in likewise situation. Then there's liable capital. So liable capital in terms of equity is the liquidation of a company, and what remains is equity. So again, I gave you an early example of if a company is worth $100,000 and all of a sudden you have to get rid of it, or you're selling it, or you have to shut it down, you have to pay all of your debts, and whatever is left, that's your equity. If it's negative, then your equity is negative. That's not so good. So those are the types of equity that are out there right now. And again, you really want to talk to your CPA and your advisor to look into these specifically from your business perspective. So there are different ways of measuring equity. So the first thing we need to understand is shareholders' equity formula. So the shareholders' equity formula is really total assets minus total liabilities. And remember, assets is equal to liabilities plus your shareholder equity. So that's one of your first places you want to start with your CPA and someone who can do business valuation from a CPA and an actuary perspective. So exactly what is the story being told here, right? Equity represents the shareholder stake in the company. So for example, if you are a sole source, not a sole source, if you are a sole member LLC, obviously you are the equity holder of that company, 100%. So if you're the sole owner, you are the shareholder of that company, okay? So again, like I just mentioned, your equity can be negative or positive. If it's positive, great. That's a great thing to have. It's a great thing to have a positive equity because that gives you a lot of leverage in your business and in negotiations, for example. If it's negative, that's a risk. So think of someone who wants to invest in your company. So if you have negative equity, that's a risky investment for that person to a certain point. It depends on the risk tolerance of that individual who's about to invest. They may have different requirements in the contract to sort of cover and leverage and sort of insure against some of that risk. But again, when you own your company, you don't want to have negative equity. It's not really a good thing to have. But again, a CPA can determine your current equity for your company. So I definitely advise you to work with the CPA to figure out what your current equity is. Do you have any questions so far? I don't see any questions, Pauline. Just want to double check.
I don't have any in the chat yet.
Oh, cool. Thank you. Thank you, Pauline. I'll ask every now and then just in case. Oh, Horace has a question.
Hey, I have a question. I don't know if this is too early, but I think you actually said something in regards to it. Like, for instance, I have a startup and my competition, their which has a similar business model, has been evaluated in the hundreds of millions, right? And mine is basically just starting up, but same or similar business model.
Mhm.
Can you compare your equity or your valuation rather in regards to what your competitions is?
Yeah, we'll definitely get into that. But to answer your
Mm.
question directly, let me put it to you this way. If you were to sell your company right now, how much would you sell it for?
Right now, today,
Mhm.
maybe about 3 million.
Okay, so we'll get into that. So what you're saying is your startup right now is much more valuable than your competition, correct?
No, I wouldn't say it's much more valuable. I would say that it's just as valuable, but it hasn't built up
Mm,
in
okay,
equity.
good, good. So that's a great question, and we're definitely going to get into it. So the way I would approach your question would be, what is the value of your business? Yes, you and your competition are in the same market, possibly in this, yeah, probably definitely in the same industry, but in the same market. But have they performed longer and have created more revenue versus your startup?
Correct.
Exactly. So they created more value in their business. Would you agree to that?
I would agree.
Yeah. So now when you compare companies, it's comparing oranges to oranges. So if someone is going to evaluate your business, they probably wouldn't compare your company with your competition, because even though you're in the same market, they were your competition, the same type of company, it's a different, they have a different revenue generated experience, put it that way. So for
Right.
example, would you compare, I wouldn't compare a shed versus $1 million house, even though they're both places, they're both domiciles, put it that way.
Hmm.
They're two different experiences. One is a very small house, 1 bedroom. It's still a house, but the other is a 10-acre mansion with a large swimming pool. And you see where I'm going with that?
I see where you're going.
Yep. So you definitely want to compare apples to apples and oranges to oranges in that sense.
Mhm.
So with the business evaluation, we definitely want to understand what is the evaluation. So the valuation itself it's an analytical process, right, of determining the current or projected worth of an asset or a company, right? So it's a process. So, but why valuation? It's just like understanding what our equity is, right? It's just like understanding what our home equity is. We should know what our home valuation is, right? And pretty much there's a lot of software, online tools, which gives us a roundabout figure with some percentage of error in there. It's not 100% accurate, but sometimes you definitely want to get your home evaluated for insurance purposes, refinancing purposes, for example. So you need to know exactly what the value of your home is. Just like in business, someone needs to look and assess what the value of your business is. Now, what is considered when we talk about measuring the business value? Like now I keep going back to the house and the home analogy, because it's almost similar. It's a great analogy. I love that analogy because it gives us something tangible to touch on. So we look from a business perspective, we look at the overall management structure of a company. These are some of the things that are considered. So you look at the overall management structure, what's there? Is it the sound structure? What is the experience of the people? Things like that. What are the future earnings potential of that company? And again, future earnings is a projection based on actuals from the previous years, right? If you're a startup, then we're just looking at future projections. And you go from there. And then we look at the current assets and the market value of the current assets. So that's kind of where I would look at it. And before I move on, is there any questions, Pauline, just in case, in the chat room? You're muted.
I did see a chat.
I was trying the space bar to help me unmute, but obviously that didn't work very well. Okay, so we do have a question here, and it is trying to get to that. Related to equity, how do you really add partners and share the equity with them? Or I guess, how do you compare a potential partner contribution with the equity that will offer to them and what you expect the value of the business to be?
So essentially the question is, it's related to equity. So if you're going to add partners to the company, so I'm just going to say if you're going to partners, meaning investors. So that's the way I would look at that question. If you're adding partners to the company, what contribution would that partner have into the company? Well, part of it obviously is negotiation. Let's say I'm going to use myself for example. If I wanted to be a partner in your company, I would definitely want to know what is the current valuation, and we would have to go through that assessment to find out, what is the current valuation and what are you offering that particular person? What would you offer someone investing in your company? Is it a percentage of the shares of your company? Are you partnering because you want to pay off debt? What is your debt load? All those questions have to be taken into consideration. How is a partner that you're asking to be part of your company, even if it's a service company, how are they going to get their money back, right? Or is there a negotiation possibility where, maybe you can reinvest their share back into the company as a reinvestment into the company? So there's a lot of different issues and a lot of different things that you want to think of and answer prior to making that commitment. In a question like this, obviously that sounds more like a contract or negotiation tactic. I would definitely have, again, your CPA and your attorney walk you through those two steps, because there is some negotiation and definitely some numbers that you need to understand in your business. So hopefully that helped. And if I didn't answer your question, please by all means, you can unmute and you can just type your question in the chat room. So business evaluation, generally speaking, there's simply two approaches, right? But within those two approaches, there are different ways of determining the business valuation. So there's a relative approach, right? That's the first approach. Relative obviously means related to the market. And this goes to your initial question about comparing your startup to a company, to your competition. It's compared to businesses that are similar to your company. Now, similar means not just the industry or the market, but it also means looking at your revenue stream as well. Comparing a $500,000 revenue per year company to a $20 million revenue per year company, even if it's the same restaurant, for example, that's a tough comparison, because you're comparing that's apples to oranges there. So whenever you talk about doing a relative comparison, that's what we're talking about. That's actually external. It's related to the market. Okay. And it's just multiple businesses. So again, using the home analogy, you would want to compare your house or your property to properties that are similar to yours in size, in amenities. For example, if it's a 2-bedroom, a 2-bathroom with a finished basement, then you kind of want to compare your house within a certain mile radius of the same type of house, So in the business, it's similar to that. Are you in the same geographic region, in the same geographic market, for example? And are your revenues about in the same threshold? So you compare yourself to other businesses in that way. Another approach is absolute, right? Just one company. You're a company. You look at dividends, your cash flow, and your growth rate. Those are some of the three things that involved in looking at just comparing yourself to yourself. What is it about your company that's really, really cool? Is it unique? What are your dividends? What's your cash flow? What's your growth rate? What's happening in your company? However, what really happens is when you look at business evaluation, most places actually probably do it, they use a combination of the two. It's asset-based, income-based, and market-based. So obviously asset-based is what the company owns. Income-based is what's coming into the company, right? Market-based is also in a relative sense. So how are you comparing yourself, the company, to other companies in the area that are similar to yours? So most evaluators probably they definitely use the combination aspect, because you want to have a good balance of looking internal at your company, now comparing yourself externally to the general marketplace. So earlier I talked about we definitely want to increase both our equity and our value of the company. But why do we want to increase both? So let me answer a question. And you can unmute yourself or just raise your hand, or you can type the answer and Pauline can tell me what the answer is. Why do you want to increase our equity and valuation? If someone offered you $1 million right now for your business, what would you say? You can either unmute or you can type in your answer that Pauline's going to read off. No one? Okay. All right.
Charles said, enjoy.
Enjoy. Okay. I don't know what that means, but all right. What do you mean by that, Charles? Okay. I think it popped up just now. I said they can have it. All right, cool. All right.
I put in too much time in my business to take $1 million. I'm expecting more.
Okay. Okay. All right. So most people, right. So anyone else, Pauline?
We have, I would say it's worth more than $1 million, but I just don't know how much.
Exactly. That's another great answer. Appreciate that. So what would happen is if someone offered you $1 million for, think of, let's put it in different terms. If someone offered you $1 million for your house, you would probably say, sure, cut the check and run. What I would say is, why would someone offer you $1 million to your business? Is it worth $1 million? Is it worth more than $1 million? So you definitely want to know the value of your business, right? So when someone says, hey, I want to offer you $1 million for your business, well, then you know it's worth X amount of dollars. So you can either say, no, my business is worth X amount. You can either meet me there or we can negotiate. But if you don't know the answer, then there's another challenge. So the idea is we have to remember we must know what the value of our business is. We have to know that. And it's always helpful to go through that exercise at a certain point in the creation of our business and the development of our business and in the progress of our business. So think of it in those terms. I think Pauline, I just saw a comment from, I opened my chat so I can definitely see something.
Okay.
But go ahead, Monique said something.
Yes, usually buyers try to give the lowest cost, meaning it's valued higher. That's true.
There you go. That's very true, because they're testing you, right? They probably know the value of your business before you even know it, because you can actually do some analysis of the market and the market value based on public information, things like that. So businesses do that. Evaluators do that kind of information, just like, again, the value of your house. You can go to certain websites and find out the value of your home within some percentage of error, plus or minus some percentage of error. So it's always good for you to know what the actual value is so that you can be prepared for doing that. So the question is always here, why do we want to know? Why do we want to know it? And why do we want to increase that value? Okay. So this is an example that I really like. All right. Let me close this chat room real quick. Last year, almost a year ago, actually, Joe Rogan, through the Joe Rogan Experience podcast, He was, rumor is, he was offered $100 million to move to Spotify exclusively to Spotify. It included the video and audio portion of his podcast, because if you've been following Joe Rogan, you know, he used to have his podcast, his actual podcast produce video, and he would put that on YouTube. And part of this exclusive deal was, remember, he left Google, he left YouTube, and he left Apple, and he's exclusively on Spotify now. So what really made this deal really, really good for the Joe Rogan Experience podcast company? So Spotify stock went, once they made the announcement, it went from $161 to $181 during a 3-day period. Okay. Remember, they offered Joe Rogan a $100 million contract, rumored. I haven't seen reports on the exact figure, but the figure was $100 million, a little bit plus. But just by offering that to Joe Rogan as an exclusive deal, Spotify gained $5 billion in market value. Right? That's quite amazing. That's really amazing. So what does that tell you? Spotify invested a certain amount, just $100 million, because they gained $5 billion in such a short period of time. Okay, that was a year ago. And I love this example because it shows clearly that once you invest in your company, that's how you can actually improve your valuation and even your equity to a certain degree. So if a company just earned $5 billion by investing 100 million, that's pretty incredible. That's a great return on your investment. So start thinking of it in those terms, okay? So how do we build both? I think we have a question in the chat room.
We do.
Okay.
And it says, you may get to this, how to value your customer base and the information you have on purchasing history.
Okay. How to value your customer base and the information you have on their purchasing history. Okay, we'll definitely get into that. This might help in terms of doing that. So how do we increase our business equity and business valuation, right? So if you had $100,000 to purchase a company, right? You have $100,000 cash. And that particular company that you're about to purchase, it will return $1 million. Would you purchase a franchise business, or would you purchase a startup business? Which one would you invest in? If you can type it in the chat. So if you had $100,000 to purchase a company, yep, they would purchase a franchise business.
Yeah.
So let me ask you this. There you go. The answers in the chat. Why would you purchase a franchise business? And very, very savvy answers. Yes, because they already have a proven business plan. They have a proven system. But let me ask you this. Why wouldn't you do a startup besides the proven business plan and the franchise? From a financial perspective, why? And you can unmute yourself. I'd love for this to be interactive. Why would you not put your $100,000 in a startup business? So the reason is that, and I want you to think about this. Yes, the franchise business does have a proven business plan. They already have systems in their business. When you buy a startup, you still have to spend your $100,000, but you're not going to make $1 million because you have to put more money to create those systems in your business, right? You would have to create your management system, your operationals manual, your sales systems, your marketing systems, your financial systems. You may have purchased it for $100,000, But now you have to invest even more to do all those things in the business. So it's really about the systems in your business. So this is thanks Monique. No problem. Just unmute yourself. You're fine. Don't be shy. So that's exactly it. So I like this image because it goes back to the question I have. So let me ask you, I'm going to ask you this. On my left, my screen left is the shed. And on screen right is that beautiful home that's open and looks very modern. So you have $100,000. Now, in the chat, which house would you buy for $100,000? You can buy one or the other for $100,000. Which one would you buy? The shack on the left or the beautiful modern home on the right?
I'm buying the shack, but that's just me. There's always room for improvement.
Yeah,
I'll take the
right.
one right.
There you go. The shack, modern house. Okay. So we got about a 50-50 split here. Okay. So what if I told you that the shack location, the shack on the left, screen left, is actually sitting on minerals underground. There's a lot of minerals there. It could be oil, it could be diamonds, it could be, a lot of minerals that you can actually excavate. But the house on the right, same size land, all you're buying is a house. Now, which one would you buy? And for those who said shack, same answer.
Yeah.
Right. You would definitely buy the shack. And that's the way you want to look at your business. Yep, the shack. So still voting for the shack. I'm liking Michelle. So the idea there is careful for what you see. Always do your research and find out, well, why is that person selling this for $100,000? What's there? It's the same thing in your business. Why is someone offering me $1 million check for my business? What do they know that I don't? They probably know your business value more than you do. So you certainly want to be able to be sure that you know the value of what you have and you understand where the value is and you understand how to improve that value, right? So if you had $100,000, you can probably improve that shack, and then probably knowing what's underneath it, the value of, there you go, look at the forest, not just the trees. You definitely want to improve that shack, for example, but now you've doubled your investment. And obviously you definitely want to just, maybe sell it for a lot more because now you know the true value of it. You know that there's minerals, you know that there's a beautiful home there. Now you know, boom, now it's a lot more valuable. So think of it in those terms always. So really and truly, it's about what's within, okay? So we already talked about your numbers before, right, in the previous webinars. Again, just to kind of recap, in your business, do you have low debt and high cash flow reserve? Because we're in a pandemic, because we're under this pandemic from 2020, I can tell you that cash reserves and many of the businesses have been depleted. This is why the triple P, the PPP, and the IDLE came to fruition. So that was an injection in the business and the economy, but it also created debt in the economy. Okay, the Treasury printed money. There's debt in the economy because those are loans. But again, businesses have to pay back those loans. There's a debt. There's a higher debt. So you have to think of it in your business terms. Lower your debt and increase your cash flow reserve. Now that we've seen what happened, I know a lot of consultants, including myself, who I would normally tell a lot of my clients or anyone that's asking me for just basic business advice is, how much cash flow should you have to save in case of a rainy day? I would just say, normally I would say about a quarter to 4 months or a quarter, 3 to 4 months of operational cash flow, bank it and don't even touch it. A lot of us are now saying a year. If you can save up for a year of your operation expenses, put that in the bank, leave it alone, or start building towards that saving number. That's one of your goals. Start building that, right? that helps you with your equity in the business valuation as well. I want to go back to a question, so I'll make sure I did not miss it. It was, yeah, how to value your customer base and information you have in their purchasing history. Yeah, well, definitely, that's something that we're going to talk about right here. So do you have a manual of operations in place? Your how-to, the franchising part of it, right? Now, you may not be a franchise business, but if you grow your business, you definitely want to have operation manuals. When someone buys your business, right, if you're going to sell it and someone buys it, they want it turnkey. That helps improve the sale of your company. Because if someone's, let's say you want to go and buy a car, right? I'm going to go buy a car. Wait a minute, I got to buy an engine too. I got to buy the tires. I'm not investing in that car. Same thing in your business. Wait, I gotta go in and I gotta build a kitchen. Then I gotta write a manual on how to cook. You don't have all that, then guess what? Your evaluation gets lower and lower and lower. So you have your leverage for negotiation. You're depleting it. You're hurting yourself. So think about those things. How-to manuals are so important. Do you have a good management team? Is it just you? Okay, but you can also hire a management team like, a fractional CFO, a fractional COO, a fractional CPA. You can put those people on your management team, but who are they? You definitely want to have that, because if you have a really good team, they'll help you through this process. And it goes back to, what are your management systems? Your management systems are your hiring systems, firing systems, things like that. Do you have a 401k plan in your business? What are those things? What do you have in your business? Is your team highly qualified? Sometimes you're highly team qualified. If you're selling a larger company, sometimes some of the assets are the resources in your company, and resources are human resources in the company. So if you have a highly skilled labor in your company, that improves also your business valuation. Some of us don't think about it, but that's exactly what it does. Think of a lot of the IT companies, or a lot of companies who are going into creating rockets and creating those high-end scientific products and services. If you buy those companies, you're talking about extremely high-skilled, very high qualified teams in there. So a lot of scientists, a lot of mathematicians in there. So those are the people that you're also investing in when you purchase that company. And again, how automatic is your company, and how flexible is your company? Now, I want to spend maybe a minute or two on flexibility. Because of the pandemic and what we experienced last year, the flexibility comes from pivoting. Can your business pivot? Can you shift? Can you turn? Are you flexible? If your company can't do that, and you're very rigid in your management team, your systems, your numbers, if you're very rigid, business owners, people who buy businesses, they would look at it and say, there's not much I can do. I'm just buying a concrete block. I'm not buying a Play-Doh. I can still be in business, but I can shift a little bit. I can make this, I can make that. So that's part of that flexibility. And what we saw once the pandemic hit a year ago, once we shut down, and a lot of businesses just didn't know how to pivot. Why? And I'll go back to our previous webinars, is let me see your business plan. Do you have one? If you don't have a business plan, start writing one. By now, based on all these webinars, you should have your business plan up and running at this point. But you certainly want to be able to understand how you can shift your business. Now, an example that I like to use is, there's a company in Montgomery County. They do a lot of entertainment stuff. So what they do is they used to do outdoor parties, and they were an entertainment company, and they facilitated people who would, they set up tables, and they do all the decorations for you. The pandemic hit, they lost all their business. But because of their skill set, they shifted into making the plastic face mask that goes over your face. And they actually started making in their warehouse, they started making regular face masks. And this was a decision they made immediately. And they survived, and they're back in business. So it's the creativity of your management team. It's the creativity of your business operations. They actually had the equipment in-house not for that purpose. They were doing different things, but they actually had the sewing machines and they had the skill set to be creative and do those things and respond to an immediate need without much investment in their company. All they did was, okay, let's repurpose our equipment. We're not making money here. But now if someone wants to buy that company, there's another line of revenue that they actually can invest in. So you definitely want to be able to shift and pivot and be flexible in your company and that's very, very attractive for a lot of companies. So when it comes to having your customer base and information you have on purchasing history, um, I would say yes. Um, because if you have a large customer base, that means that people want that product or service that you're selling, that you're offering. So if you have that, yes. A lot of that, it, that does have a factor. How much of a factor? I guess it depends on the type of business that you're in, on the type of service that you're doing. It really depends. If it's, for example, if it's a really unique product at a very high end price, then yes, there's an impact there. But if you're also selling something that's a commodity, like if you're selling pencils and you have a large database of people buying pencils and you're not unique enough, for example, then it doesn't really matter how many people buy your pencils unless you have something unique, that you have a customer base that they're buying your pencils, for example. So that's that's keep that in mind as well. So yeah, yes. So sometimes Michelle wrote in here, good advice is to listen to what your customers are asking for. This will help you grow and pivot your business. 100%. The market will speak to your business, right? The market will tell you, hey, we love your product. Could you do this? This week, actually, I worked with two of my clients, and that's exactly what occurred. One of my clients, they created a certain packaging, and my client put certain things in the package, and the client put it on the website. People wanted the package. They didn't want the stuff that was in there, but they wanted the package because it was beautifully made. So the client and I talked about it, and I said, hey, this is something that's going to happen. The other client, same exact situation. There's this really cool story I want to share with you on exactly that. And I have to write it down because I need to find the original story. It's the story of I guess I want to say it's a major magazine, I think, out of New York City or New York State. And this was back in the day when people used to get magazines home, you know, to buy stuff out, the catalogs, not like online right now. So that tells you how old I am. So people used to get the catalogs. So on the front of this catalog was an elephant, and they were selling the sari, which Indian women wear with the dress.
Mhm.
And they wrapped, like on the elephant trunk, they would put the sari on the trunk and they would drape the sari over the elephant, and the women, they were selling saris, for example. This particular company got certain calls asking, how much is your elephant? There's certain people in the market who was saying, can I buy the elephant? They weren't selling the elephant, obviously, but they were saying, hey, you're selling the elephant, so could I buy the elephant? It could have been a zoo, it could have been some collector or someone who just wanted an elephant. So the idea there is, the lesson there, and what we should get out of that lesson is, listen to what the market is saying. Be ready to sell your elephant. What is the elephant in your business? Okay. And this is a bit more of your product pricing and product placement and things like that. Your product offerings, but always have the elephant and listen to what the market is asking you, because yes, that does include that could create a new product line for you, for a new revenue stream, a new income stream for your company. So think of it in those terms. So could that company go and sell elephants? Probably not, because that's not what they particularly do. But the analogy or the lesson is, have something in your business that's really the elephant, quote unquote, in your business, so that if someone says, could you do this huge contract, or could you deliver this service, or could you deliver this product, be ready for it. That's essentially the takeaway from that particular story. That's what I got out of that story, which is really cool. So when we talk about, so now in conclusion, these are just a few areas to consider. I talked a little bit about earlier. You definitely want to analyze your business plan. By all means, go back and update and analyze your business plan. Update the analysis for every update your analysis for every new level of revenue. So let's say this year you make $100,000. Next year you make $1 million. Do a business evaluation. Understand, is my company really worth $1 million because of my revenue? Okay, but what is it really worth? I might be making $1 million in revenue, but what is your true profit? Your profit might be $100,000. So, understand those numbers, contact your CPA and start working with your CPA. And if you're going to bring partners into your business, you better have a good attorney who can negotiate on your behalf but they also have to work with your CPA to give you an understanding of where you are in the negotiation process. What's your leverage? What can you accept? What can't you not accept? It's called your BATNA and your WATNA in terms of walking away. So there's a piece that you say yes to, and there's a piece that you say no to, and then there's your middle piece. What's your most probable area that both parties will fall sort of like in the middle. I'm not going to, sort of like the negotiation piece. So understand understand your evaluation and equity throughout as your business grows. Okay. And I'm going to say this again, update your business plan, analyze your business plan. Your business plan is a working document. Take a look at what you initially start off with. And then when you executed your business, it doesn't matter if you're a business for 10 years or 5 years or 100 years, go back and analyze your business. Where has my business changed this quarter or half the year? Or where have my business changed this year? And how do I plan for the foreseeable future? So I would say those are a couple areas that you want to consider. So again, with that, I would leave it there for now. If anyone has any questions, I'd certainly appreciate it. And again, this is your session. And please, this is an interactive session, so you can always unmute yourself, or you can ask a question in the chat. And if you have a comment, just please, let's just chat about it as well. This is your webinar.
A question. This is Monique, and I apologize for not showing my face. I'm not quite camera ready right now. When should your business increase, and what's the average number of years that your business valuation should have some value to it? Like, does it happen for some companies immediately, or how they say 5 years will make or break a company? So when should you have some kind of valuation in your? Is that a question you can't really answer, or how?
No. That's actually a really good question. Is there a specific business that you want to dive into right now?
Yeah, well, I do have a business. I'm trying to develop 2 businesses. And one is like an event planning kind of, it involves events, but, I would like to get a brick and mortar. So I know that the valuation is not much now. It will probably be more once there's like a projected, well, I do have projected income, but once, people can come and sit down and be in the building. And then the other one is educational consulting, which I just started.
Okay, so what I recommend is always looking at, this is when you write your business plan, there are 2 areas that I always emphasize besides the numbers. is your industry analysis and your market analysis. Within the two markets that you just described, you want to kind of have a general idea of what businesses actually do in those two markets: education consulting and event planning. So you want to understand the lay of the land when it comes to when those businesses actually increase value in a very aggregate level. Okay, so that's a general answer. Now, here's a couple more things I'd like to add. Outside of those two examples that you just provided, what you're trying to do is think of this as an idea. So if someone has an idea, right, and that idea has an immediate impact on the economy on a very large scale, and they actually patent that idea, now the idea has a little bit more value because now it's ownership. So no one can actually, quote unquote, steal it or replicate it without permission. So that also gives it a little bit of valuation, even if it's an idea. Now, once the idea becomes reality, let's just say it's a new code, it's a new program that does an amazing widgetry on doing data analytics, for example. And I'll just use artificial intelligence as an example. What if you created something that would impact the artificial intelligence community in such a way that it's very unique? And that's day one of doing that. The evaluation it will just be off the charts, because that's a larger, high-end, high-invested community, because it impacts a larger area. Now, if you're looking at valuation for your event planning company, you would probably have to build your company over time, yes, to create value in the company. What are some of the unique things that you're doing for event planning? How are you getting clients, and what is your revenue, profit, and loss? Things like that. What are the numbers? How are you increasing your business? What is the growth rate of your company? So they want to look at all those things. Now, if it takes 5 years, I don't know. I don't usually put time on it. I just put effort. Could you do it in a year? Yeah, sure. But it's your effort that will do that. That shows your growth rate. Your education consulting company, it's the same thing. It's how fast do you grow the company? There are some franchises who are in educational consulting, and they've grown exponentially, and they've done really well. So those companies, and they've actually gone global outside the US. So those companies will have a greater valuation because of their growth rate. So it's about the investment, and it's about what they get out of the investment. So there isn't really a timeline, I would say. To me, it's about the effort. It's about what is the rate of growth for your company? What is the uniqueness of your company? Are you bringing something unique in educational consulting that's different than anyone else? That can create an impact, a larger impact, a quicker impact right away. And if you can show that and have investors, I think someone asked about investing in the company or bringing in partners. People want to invest in your company. So that means that they see your company as having value, and they would give you X amount of dollars above the average. So there's a lot of factors there. I'm trying my best to navigate you through different factors, because there's so much in there, but I hope I answered your question.
You did, thank you. And one more question. I don't want to hog up the questions. In terms of reserves, what kind of account would you put the money in to gain the most interest, but also to have it somewhat available? Like with this pandemic, people needed to have their cash available immediately almost.
Yeah. What kind of account? Well, let me put it to you this way. When I talk about cash reserves, that's actually your net. So whatever you do before you get to your net, that's all. Whether you invest some of that money back into your business, or you speak to an investor, a business investor who can handle that money, for example, or that investment, like a CPA or a licensed a licensed investor, a financial planner, they can guide you exactly where those monies can go to. Normally, the safest answer is a bank, to be honest with you, the bank of your choice. But what I would also say is that money should just be put away. It's zero. If your operations overhead, if your operations on a monthly basis is $10,000 a month, then if you build your business over time and you have $120,000 in savings, that's zero. Okay, you don't touch it, you don't do anything with it. It's still an expense to your company because savings is an expense to your company because it comes out of your profit side, because prior to the profit side, it comes out of your gross profit margin, but it's an expense to the company. But leave it, save it, because it's emergency funds. So short answer, I would just say put it in a safe and legal FDIC backed bank, I would tell you. And if you want to invest other money, then you have to speak to an investor about how to handle that piece of it. Yes, Pauline.
Oh, I was just going to say, I like Michelle's answer, under the mattress.
No, what's funny is I was about to say that, but I was like, nah, let me not say that. Because if your house burns down, there goes your savings.
It burns with it. Mm-hmm.
Yeah. So, no, I hear you. I definitely hear you. No, I mean, yeah, the pandemic has really created havoc in a lot of ways. And I'll just be, honest here, as of today, some of the states are considering, and some of the states are considering opening 100%, or they're scaling up from 25% or 50%, 75%. In our area, in my region, the DC, Maryland, Virginia region, we're still pretty much low in terms of our percentage open. So I can tell you, especially in the food industry, a lot of restaurants had a hard time pivoting. A lot of restaurants had a hard time, and they've lost equity. They've lost their business valuation. Some restaurants have shut down, and we've seen them in the area. Some restaurants have moved out of the region. Let's just be real about it, because it's their decision. So if you're hiding your money under your mattress, I know you're joking, just be careful. That's also risky. The money isn't working for you. So if you put it in the bank, even if it's extremely low interest, the money at least gives you something back. It still works for you. You want your money to work for you. The money you have is your employee. They need to work for you, and they need to bring a little bit more revenue for what you're doing with them. So yeah. So hopefully that answers your question. Hopefully this helps everyone. I really do.
I think that this is a good title for another webinar. Money is your employee. Honestly.
All right, I won't say what Monique says. I'm sorry, Michelle, because this is a recorded session. So Michelle has all her money in the bank. Let's just put it that way. So actually that's actually a good topic. I'm gonna write that down. Money is your employee. You definitely want your money to work for you. Definitely want it to work for you. It's money. Remember, money is a tool. Money is a tool. When you have $1, you want to make $2. So that money has to work for you. The money has to double itself, but you have to make it work. So I look at money as a tool, but it's a great analogy. Money is your employee as well. And that's all I have, Pauline. If there's no other questions, that's really all I have. And I want to say thank you again. So I appreciate this, and I hope this was helpful for everyone.
Okay, well, before people, as we're winding down, if I could put up our nightly closing poll, that would be fantastic. If you could take a moment to answer the questions. And so I'm going to launch it right now. And then Eric, if you'd like to do your closeout, and then I'll follow up with mine.
Sure. Thank you.
Oh, did you want me to do my closeout first?
No, I'm actually pulling up the slides.
I'm sorry.
No, you're fine. You're fine. I'm just trying to pull up the slides. So, as I mentioned earlier, we have this programmatic approach to our webinars. And again, this was webinar number 9. And we have 3 more to go in this particular section. So next week we're doing number 10. And next week we'll have this great speaker. Her name is Dr. Terry Levine, and she's going to be talking about sales and marketing. How do you get qualified leads who want to pay you to work with you? So next week is going to be fun. Dr. Levine is this amazing speaker. She's traveled all over many different places doing this work, and she's written a couple books. She's a really cool person. I've talked to her many times. She's really fun. So this is going to be really cool. So how to get people how to get qualified leads that people want to pay for your products and services. So I'm really excited to hear what she has to say next week as well to everyone here on the webinar. So with that, Pauline, I'm going to turn over to you, and thank you again.
Okay, no, absolutely. Thank you. And thank everybody for attending this evening. Let's see, again, another informative webinar by 1917. William Eric Lindsay, you always do a fantastic job for us, and your team has been absolutely exceptional, and we appreciate you. And again, now more than ever, we do need our business plans. And again, thank you, everyone. If you'd like to rewatch the video, we will be posting it on YouTube. Again, good night. Thank you.